What if I told you that I could predict the price of gold? Yeah, I'd be lying, but I can give you something to help. That's better than nothing. So here's something to think about. Kind of a strange thing. Whenever we see small drops in gold price, whether that's daily or weekly trading, people tend to grab that trend and extrapolate it. They think that gold is going to continue dropping. Just take a spin through the comments from any of last week's videos I put out. You're going to see people saying they're waiting for gold to hit $1,600 and then they'll jump back in. Now, I'm not picking on anyone. Some people probably do have solid rationale there. Maybe they have significant positions. Maybe they aren't in any rush to add to them, but most people see that short-term slope and they just draw out a straight line going at that same angle. And that sentiment that price is going down, well, that tends to spread pretty quickly with no good reason. We really shouldn't even be watching daily price fluctuations unless we're trading gold, which very few of us here actually are. And those who do trade, they pay attention to other things. They have charts that show moving averages that smooth out these fluctuations. They show actual trends. Now, the thing that we all need to understand is what's actually affecting this stuff. And I don't think that I've ever heard anyone explain it. I've heard people say things like gold price tracks inversely to the Dixie, but that is not a historical correlation. It's a relatively new thing. It makes me wonder if the people making those comments understand what they're repeating to begin with. So we're going to try to fix that. At a base level, we all know about supply and demand. Gold's a commodity. It operates the same as any other. When more people are buying and supply is limited, price goes up. Now, a lot of things affect demand, political unrest, central bank policies, retail buying. We all get that. But here's where this gets really important for any of us trying to guess at where the price of gold is going. Now, what's relatively new is that the strength of the US dollar and US Treasury yields, they have direct impact on price fluctuations. Now, last week, it's a really good example of this effect. We saw PCE numbers come in higher than expected, and we saw the Federal Reserve minutes show that some of the members wanted to consider a 50 basis point rate hike. Now, both of those data points were bad for gold because they were good for the US dollar. Now, the reason that this is happening now, but hasn't really been a good historical indicator, is that bond yields just have not been exciting. Interest rates haven't been high enough to make them attractive, but that's changed. There are two big reasons here that the correlation between the price of gold and the strength of the US dollar is so direct. Now, the first is that since gold is priced in US dollars, when the US dollar is strong, it can make gold more expensive for buyers using other currencies. Higher prices decrease demand, causes prices to fall. Now, the opposite is true as well. When the US dollar is weak, well, gold is cheaper for buyers using other currencies. Lower relative prices increase demand. That pushes the price back up in terms of US dollars. The second has to do with Treasury yields. The US Treasury bond yield is a key benchmark for global interest rates. So when Treasury yields rise, other investments get more attractive because they offer higher returns. When Treasury yields fall, well, gold is more attractive in that traditional role as a safe haven asset because the competing options are now underperforming. There are a lot of factors in play with gold price, but the US dollar, its impact is the one that's causing so much of the fluctuation right now. So if you're trying to forecast any kind of trend with this stuff, well, one way to get a gut check on your thought process is to just ask yourself if the reverse is likely with the US dollar. If you think gold is going to fall 13% down to $1,600 without any huge shift otherwise, without any shift in demand, well, do you think that the strength of the US dollar is going to gain 13%? What's the offset? This is the logic behind the pivot that we talk about. When interest rates and treasury yields are cut, while the lower returns on interest-based investments get less attractive, that means that gold demand will go up. So if you find yourself getting caught up in short-term price movement, and it's really easy to do that when you have YouTube channels just jumping on every price move, just keep the bigger picture in mind. Ask yourself if demand is changing, if the USD exchange rate is changing, if interest rates and treasury yields are changing. Because even though none of us has a completely clear picture into what's actually happening with those figures, we at least know that those changes are slow and they're controlled. The Fed is not going to change something suddenly like a 2% rate increase. Central banks are not going to suddenly reverse buying policies. As to whether or not gold prices will continue falling, definitely possible. I'm actually assuming that we'll see buying opportunities leading up to June, but I'm not expecting a 13% drop in price. As far as current price goes, whether gold is actually on sale right now, well, at 1812, that was the closing spot price on Friday, we're still ahead of where gold was at in mid-December, just a few months before. We're also still ahead of the 200-day moving average, so the run up to 1940, that was the oddity, that was the breakout. Anyone trading on that run, well, they're the ones that got beat up. And anyone buying on it, well, they were buying on a high. I actually sold some gold to help consolidate some of what I have. I'm going to come back to that. Now, I wasn't really sure that it was high, but it felt pretty likely. Now, last week's drop to 1820 makes it feel like a better time to buy, but we could still see it go lower. Current price still above the 200 DMA. Now, I think the 200 DMA is like 1784 right now. Maybe I'm off slightly. Regardless, gold could go to 1850. It could drop into the 1700s, and none of that would be a change to long-term trend. If the spot price of gold fell into the 1600s, though, and some of those people were saying 1600 flat, well, that would require a very big gain in the strength of the US dollar, maybe a big geopolitical improvement that would make central banks and retail buyers no longer interested in gold. Well, do we think that's likely? I'm going to leave the conclusions to you. This is just meant as insight into where prices are going. It's not going to help with daily or weekly moves. None of us know where PCE numbers are going to come in, CPI numbers are going to come in, but it should help with trend spotting, and it should help with peace of mind. And that's it for this one. So let us know what you think of the current price range. Is that 1750 to 1850 a reasonable trading band, or do you think that we're going to see a continued drop? Let us know. And then while you're in the comments, be sure to hit that like button. If you found any of this interesting, be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.